Thank you for attending today's webinar, The New Revenue Recognition Rules. Today we'll be focusing on systems, data reporting, and creating a transparent audit trail. Before we get started today, we will just go over a few administrative items. We have made a copy of today's presentation available for download via the resources area on your screen. Following the webinar, all attendees will receive a copy of the presentation once again and a link to the recording. During the webinar, you are welcome to ask questions in the questions area on your screen. This is a hot topic, and we know people have a lot of questions. A lot of questions were submitted during the registration process, and we do welcome you to continue to send us questions during today's webinar. There will be a Q&A session at the end of the webinar, so we will be looking at the questions you're submitting, and we will try to answer as many as possible. If any of you are having trouble hearing the audio through your computer, a separate phone line is made available to you. It is on your screen. We do have a line for those calling in from U.S. or Canada, and then we have a separate line for those of you who are calling outside of the U.S. and Canada area. I have also made that available through the questions area on your screen. We will offer 1.5 CPE credits for today's webinar, so in order to be eligible to receive these CPE credits, you must answer at least 4 out of the 5 polling questions we administer today throughout the webinar. This is a NASBA requirement, so to receive CPE credit for a webinar, you must answer at least 70% of the questions administered, and today that will be 4 out of the 5. You will receive your CPE certificates via email within 2 to 4 weeks after the webinar. We do get a lot of questions from attendees asking if they will have if they will be able to download their CPE certificates directly at the end of the webinar, and the answer is no. We will send those to you after the webinar via email. In the resources area, you are able to download the presentations as I mentioned, and we have made a number of other resources available to you, including 2 of Protiviti's flash reports focused on the new revenue recognition standards. So please take a look at those and download them if you have not done so on our previous webcasts. We are pleased to offer this webcast in conjunction with FEI. We have been doing a revenue recognition webinar series to answer the questions that are out on the marketplace. So this webinar is also co-sponsored by FEI, so thank you to them. And they are constantly adding information to their website in their Revenue Recognition Resource Center. We've made available the URL for this center, and we do encourage you to go out there and take a look at all the different resources they've made available. I would like to introduce our first speaker, who is from Flextronics. We have 2 speakers from Flextronics today who are going to be giving us some color commentary on what's going on when it comes to revenue recognition in their organization. Kevin Forschengruber is the Vice President and Corporate Controller of Flextronics, which is a leading end-to-end supply chain solution company located in approximately 30 countries. And then the second speaker we have from Flextronics is Raji Gunasekera, and he is a Senior Director and Assistant Corporate Controller at Flextronics. And we've made available the URL to the Flextronics website if you're interested in learning more about their company. So thank you for presenting today, gentlemen. We have 3 Protiviti speakers, and Chris Wright is the first speaker from Protiviti. He's been on a consistent speaker on this revenue recognition webinar series. He's from Protiviti's New York office, and he is the firm-wide managing director for the Finance Remediation and Reporting Compliance Group, and he also leads Protiviti's East region within the United States. Steve Hobbs has also been a consistent speaker on this revenue recognition webinar series, and he's a managing director out of the San Francisco office, and he is the global leader for the firm's public company transformation solution. And our third speaker from Protiviti is Siamak Ramzana. He has over 25 years of experience, and he's a thought leader in designing solutions supporting ERP and enterprise system strategies. And Siamak will be talking about the technology or system implications that the revenue recognition standard will have on organizations. So at this time, Steve, I'll turn it over to you.
Great, Lark. Thank you. And welcome, everyone. Appreciate you taking some time to join us today. Let me go through quickly our agenda for today. We've got a fair amount that we want to cover. As Lark indicated, we have done a series, a 5-part webinar series with FEI. This is the 4th webcast. We have previous webcasts that were focused on different topics. You can see a link on this slide that you can go to if you haven't participated in those and would like to review those. You can reach those and review them on the link. And the next webinar that we'll be having, where we'll be talking about some industry-specific issues and some other emerging events will be held in July. So today we want to cover the following. One, we want to give an update on some of the technical developments as we talk about the overview of the new standard. There have been some developments related to a proposed one-year deferral of the required adoption. Since most of you on this call are involved in some portion of your transition, either at the beginning or you're through the assessment and working feverishly towards the transition, we're going to talk about some of those transition considerations and maybe some best practices for how others are looking at this. Then we're going to have a focus today on some of the systems and data issues for which CIAMIC is going to lead that discussion. And then Chris is going to walk us through some of the other reporting considerations that are emerging as companies look at the impact of this. And then, as Lark indicated, we're just excited to have Kevin and Raji join us from Flextronics, and they're going to weigh in as we go throughout the webinar today on their experiences and some of the key lessons that they've learned at Flextronics, which we think will be very interesting and relevant to this group. At Protiviti, we believe that anytime you embark on a significant transformation like revenue recognition, that you need to look at it at a holistic view. So these webinars that we've had have been focused on the way that we would recommend that you look at the potential impacts of this new standard. And as you can see on this slide, we call them the 6 elements of infrastructure. In previous webinars, we have focused on the adoption methodologies, what it impact to accounting policies, some of those implications. Our webinars have focused on what it means to the processes and to the controls environment and some of the people considerations as well. And as I indicated previously, one of our deep dive focus today is going to be around the systems and data requirements and some of the other reporting considerations that companies need to consider. This topic continues to have a fair amount of press related to it. This standard is not without controversy, so it's ever evolving. And we're going to talk about the proposed deferral. In addition, we've begun to see some guidance, implementation guidance, so some clarification that's coming out of the resource group that's taking a look at those. So on May 12th, we saw an exposure draft addressing guidance on specifics around identifying performance obligations and then some specifics around dealing with licensing arrangements. So I think there's probably more to come. And then there's certainly a focus of the regulators, certainly the SEC, the PCAOB, and others are weighing in on this topic. Hopefully, if you haven't seen these on agendas for audit committee meetings and on discussions with external auditors, you soon will, because it's something that's clearly on the mind of the board of directors and certainly with the external audit community. So let's first just talk a little bit about the deferral. The deferral the announcement came on April 1st of this year. Many of us thought that was an April Fool's joke, but it really wasn't. And I don't think it was a surprise to most of us. But effectively, what the proposed adoption, would be to defer the adoption by 1 year from what was in the original pronouncement. There's a 30-day comment period. I think the guys at Flextronics will talk a little bit about their approach to the comment letter process and some thoughts that they have about this. So certainly the impact from this, in the original release, companies would have had to start the adoption for calendar year companies. It would have been in 2017. and for the interim periods of that year. The private companies have a 1-year deferral on top of what the public companies have. So effectively, what this adoption would, what the exposure draft would do is defer this by 1 year. What that means to us on the call today is that you have another year to get ready. Some companies are ahead of the game and are moving very quickly towards the transition, and many of us haven't started yet. As I indicated before, this really wasn't a surprise. It's kind of been baked into the assumption, I think, all along that many companies would push back. But from everything that we can see and what we're hearing from our clients, everybody's moving forward full steam with this. And that's our advice and counsel to companies. I think the Flextronics guys will echo that as they think about what a potential delay, what that means for them and their organization. And then I think we need to realize that this standard now has been out almost a year. And so the fact that it's deferred a year, if you haven't started or you're just in the early part of the transition process, realize that that year of deferral may have already been eaten up as it relates to the time that you have. I think many of you may be aware, but with the deferral, there's also a provision in the exposure draft that it would allow companies to early adopt. But the early adoption would be as of the original date. So that throws a new wrinkle into things as companies consider early adoption under the original timeline. Companies are going to think that might make companies think a little differently about whether they were going to use the retrospective approach versus the prospective approach. And we think this potential deferral, I think it's going to be great for many companies, but I think there's a number of companies that are, as indicated before, they're full steam ahead. They're moving forward with this and likely try to adopt in that first quarter of 2017. And so that will cause some interesting discussions, particularly if you're an organization that others in your industry decide to early adopt. And I think, as most of you are aware, the impact of this standard is likely to increase revenue that's going to be recognized earlier. And so there's a propensity, or many companies will be thinking about the retroactive application of this standard. So another wrinkle here that companies need to be thinking about at this point. So a couple of thoughts. In light of these recent development, here's some things I think you should consider is if you use this time wisely, take the opportunity. If you haven't really assessed the impact of this, now is the time to really get a sense for what it means to you. If you're already well on the way, you're probably likely going to have surprises as time goes along. So we suggest that you keep the pedal to the metal, if you will, and continue to figure out what this is going to mean, because and I think the Flextronics folks again today will talk about some of the surprises and issues that they hadn't originally contemplated that have now arisen and really going to impact their ability to make an effective transition. And then I think we all need to go into this with our eyes open as to there are a lot of uncertainties out there related to this, and certainly a lot of pushback. And we're going to get we know we're going to get some clarifying guidance, so it is somewhat of a moving target. So before we get to this polling question, what I wanted to do is reach out to Kevin. And Kevin, perhaps it would be helpful for you to share your thoughts as it relates to Flextronics and what this potential deferral and some of these other recent developments, and what that means to you guys.
Thank you, Steve, for having us, and good morning to everyone on the call. We are taking this opportunity to again comment on the new standard with our industry peers. Now I say again because back in 2012 we actually commented on our prior ED to no avail, so we're going to try strength in numbers this time around. In this round of comments, we're going to specifically address questions 1, 3, and 4 of the FASB's request for comment. First, and probably most obvious, we're going to recommend that the guidance is deferred 1 year for all public companies. We support that, and this is simply because I think we all may have underestimated the significance of the changes coming from the new standard. Now, what might be a surprise is for the staff's third comment request, we are recommending that entities that apply the guidance retrospectively be given an optional 2-year deferral period. We will respectfully remind the staff, because there was a high degree of uncertainty around timing and conclusions in the standard, early preparation during the exposure drafting periods was difficult to achieve. Hard to hit that moving target, if you will. We'll also remind the staff that the FASB and IASB rightly required a significant amount of time to draft the new rules, and companies should also be allowed ample time for careful analysis and planning on their own. As Steve already highlighted, retrospective application requires 3 years of financials, and a 1-year deferral is not as much time as it sounds to effectively prepare for running parallel systems over the first 2 periods of those years. As we all know, calendar 16 is just around the corner. Finally, with respect to the fourth request for comment, we believe early adoption should be allowed. Although we are focusing on the complexities and difficulties with implementation for our company, there can also be benefits to the revised standard, as I'll talk about later, and simply stated, all companies should just be able to benefit and move towards adoption at a pace that best suits their own facts and circumstances. We don't want to dictate that for others. So, what does this mean for us? Our request for deferral has absolutely no impact on our implementation plan whatsoever. The standard is just complex, and quite simply, we need the additional time for reasons we hope will become evident later in this webinar. You may find you needed the added time as well. And with that, I'll pass it back to Lark.
Thank you, Kevin. And we'll go ahead and open up the polling question. So this is our polling question we've been asking over our webinar series. And the question is, have you read the new Financial Accounting Standards Board Accounting Standard Update? And this is the one focused on revenue recognition. So that was issued on May 28th. So the topic of our conversation today and the conversation of our webinar series in general. So the options we're asking, or we're giving you, are yes or no. So yes, that's great. If not, then no, it should be on your to-do list. So we'll go ahead and let everybody answer this question. As I mentioned, we have been asking this same question for the past 3 webinars. So we're on our 4th webinar now, and it's been interesting to see what the trends have been. And what I'll do when everybody has had time to answer this polling question, we'll go ahead and show you the results, and I'll talk about whether or not they're different from our past few webinars. I have had some questions about the CPE, so go ahead and answer this question along with the other 5 questions that in total, we'll be asking 5 questions across the webinar. You do have to answer 4 out of the 5 of the polling questions in order to earn a CPE certificate. So we'll go ahead and we'll show the polling results. I do believe most people on the webinar have answered it. And the responses are 25% said yes, they have, and about 75% of the attendees today said no, that they haven't, but it is on their to-do list, and I would say that it's very consistent with the past 3 webinars. So now that we're going along in the year, it's probably a good idea to start reading the revenue recognition standards. So we'll go ahead and continue on with our webinar today, and Chris, I'll turn it over to you.
Great, thanks, Lark. And the polling questions obviously continue to be consistent. I suspect, in fairness, not everybody on the call will need to be the person that reads it, but obviously at least somebody in the organization you're with ought to do that, or have done that in short order to begin the preparation. What we're going to do in the next few slides is cover the new standard in brief, only because although our webinar series is cumulative and this is the latest in the series, we know that not everybody's been on every other webinar, and we want to make sure that there's at least some rooting in some of the basics, also because they have implications for what some of the other speakers are going to discuss. So, as Steve mentioned in his discussion of the deferral, this standard has been out for just under a year. and the update to it, which included the deferral date, which is subject to comment and should be concluded in the next several weeks, sometime during the month of June, was issued in April. There are two transition approaches, as both Steve and our friends from Flextronics have covered. Retrospective, which is to in the year of adoption to reflect the previous 2 years if you're a public company, and it's a 3-year 10K, as if you had adopted at the beginning of those 3 years, or with a cumulative effect at the date of adoption, which, as we now know, is another decision point for companies to make, which is that they may adopt as of the 1st of 2018 or the 1st of 2017. For those that are thinking of early adopting, consistent with what Kevin said, 2016 is not that far away. 2015 for the early adopters is half over, and so those preparations would have had to be underway or concluded on how to either gather, preserve, or have the ability to go back and gather the data you need for 2015. The object of the project, which was originally a convergence exercise with the IASB, was to achieve a single comprehensive revenue recognition model. That hasn't necessarily occurred because not all of the elements of the new standard are consistent with the IASB. It is largely converged, but there are differences, and so notwithstanding that exercise, the FASB has moved forward with the new framework. It removes existing industry-specific guidance, which, as those of you who have grappled with or deal with current GAAP know, there was an abundance of that guidance, and thus the compendium of GAAP literature in support of revenue recognition is quite voluminous. This is an attempt to skinny that down to a core principle, which is that revenue recognition would depict when you've transferred goods or services that you had previously promised through a contract in a way that allows you to recognize revenue that reflects that reality. However, although it has removed industry-specific guidance, the Transition Resource Group, and even to some extent the FASB, which in their pronouncement even came out with some clarifications on how to identify performance obligations, or for companies that are in the business of licensing, how to deal with whether you've granted a license or provided access to intellectual property either at a point in time or over time. So although it has removed existing industry-specific guidance, some of that is creeping back in through those bodies. Although the transition resource groups are interesting, they are not authoritative. As a consequence, there's still a lot of uncertainty on the impact of the new standard, thus the requests for delays, which Kevin articulated quite well, and their articulation was consistent with some of the requests made by others. The high-level application of the model is that it covers 5 steps. Some of these should be consistent with what people who are public companies understand from SEC Staff Accounting Bulletin 104, where you need to have persuasive evidence of an arrangement, which would be a contract, fixed or determinable pricing, a likelihood of getting paid, which is not expressly addressed in the FASB statement, although there is reference to the need for reserves where you don't think you're going to be paid, and delivery of the goods or services that you promised. This 5-step model requires you to identify a contract with a customer, which could be in a number of forms: purchase orders, requisitions, statements of work, contracts, invoices, whatever the form of legal contract is. Then to identify what it is you're expected to deliver or do, which is the performance obligations, and there may be more than one. Determining the transaction price in total, again, fixed and consistent with fixed or determinable pricing under current SEC rules. Then allocating the transaction price to the various things you have to deliver. If you're delivering goods and services for $100, to what extent does the $100 allocate to the good or the service, for example, in a simple example. And then finally recognize the revenue when you satisfy the performance obligation, which is that you've delivered the goods or the services promised. The difficulty for companies as they adopt this and struggle with going through discovery on how this will affect them tends to revolve, we've found, having spoken to companies, in the identification of the performance obligations, which is what exactly are you delivering? Is it a bundle? Do you have to unbundle it? Is it a good and a service? Is it a warranty that's being provided or sold? And so identifying exactly what it is you're supposed to deliver and to who and when. And then number 4, allocating the transaction price to those performance obligations, especially where the contract refers to them as all for a single price, for example, and the various measures, which I'll talk about in some subsequent slides, of how to measure that. Item 2 of the 5 items and item 4 of the 5 items do seem to be where most of the heavy lifting is being done by companies that are in various states of readiness. Item 5 is hard if you haven't done item 4, and relatively easy if you have, which is to recognize the revenue once you've determined the price and determined how to allocate the price. If you're satisfied with steps 2 and 4, step 5 should be easy. If you're not, it's virtually impossible. And so that's what we're seeing companies deal with as they work with the 5 steps. There are some potential significant accounting and reporting changes. I'll touch briefly on them. They're before you on the slide. Those that have, as I mentioned earlier, just determined or promised or contractually obligated themselves to deliver more than one thing need to determine which of those separate obligations need to be made separate for accounting purposes as well. The second is that although it is best to use the highest level of evidence you have, it does allow some relaxation in the use of the residual approach for valuing using an estimated selling price. Those in the technology industry will appreciate that is a much lower burden than was the vendor-specific objective evidence, VSOE. For those who have variable consideration history and success fees or write-ups at the end, some kind of bonuses for performance, it used to be pretty much wait until you know and you've got the money in hand to recognize revenue. There was a very high bar. Under the new model, it would appear that if you have an experience doing that sort of thing and experience predicting how much it was, then you may have a pattern for being able to recognize variable consideration sooner, certainly never more than in total, but sooner. The key there is that you have the experience, but also that your experience is that you were correct, or largely correct is the way that is shaping up. Time value of money comes into play for contracts that extend over a period of time where present valuing some of the level of effort is appropriate, and of course the subjectivity there would be to what discount rate you would use. And then timing of revenue recognition, and Steve touched on this a little bit as well. There may be, certainly you'll never have more revenue in total, but you may have in certain instances organizations that used to recognize revenue when they delivered the good who may find that based on the terms of their contract they should be recognizing revenue as they go through the process of building it and delivering it. The flip side of that, there may be some who have been recognizing revenue over time who may have to wait until the event of delivery to recognize revenue. So it may be moving for them from overtime to a point in time. Contract costs in some instances would need to be capitalized. Those are presently not capitalized. Obviously, they would not be capitalized forever. The pattern on that would be such that they would live for a while on the balance sheet and amortize as part of the cost of the goods, if you will, of performing the contract. For construction and defense contracting, for that matter, long-term contracting, the cost-to-cost method may not be totally usable in all forms going forward. It may be that they have to separate some of the revenue and the cost methods. In other words, percentage of completion and SOP 81.1, which they've had and lived with since 1981, may no longer be the method that they're able to use. For construction contracts, some of the contract costs that they used to capitalize may need to be expensed, the opposite of the first point on this page. Software companies would have to determine whether a license transfers the right or provides access. That was the area where licensing implementation guidance was just given by the FASB. We talked about vendor-specific objective evidence no longer being required for software arrangements, which is, I'm sure, a great relief to companies in that industry. And then there will be a number of disclosures that I'll cover later under reporting, which would be expanded as part of this process. And finally, some of the notable implications of adopting the standard. The industries that we believe are most likely to experience significant change are software, telecom, asset management. Airlines were they're part of the lift and load revenue recognition process, more for the freight than for the passenger airlines, real estate, and then those aerospace and construction companies that deal with long-term contracts. Certainly other industries will be affected as well, some less than more. Diagnosing which it is obviously an important part of this process so that people don't overestimate the simplicity or the complexity of the process. But nobody's exempt from actually looking and making sure you understand. And then some companies may recognize revenue sooner, but those with longer delivery cycles may need to think about how they're going to start gathering the data they need to recognize revenue over time. With that, Lark, I will turn it back over to actually to the Flextronics. I'll turn it over to the folks from Flextronics.
Thanks, Chris. The number of implications and surprises that occurred as a result of the issuance of this standard for our company are, I'm not going to say were innumerable, but were so significant and so vast that it actually had me going down the path of wanting deferral through my retirement before we actually had to implement. Today, we believe the most significant implication for our company is a shift in revenue recognition from a delivery model or point in time to an over time model or on a continuous basis, which is akin to percentage of completion accounting over the manufacturing process. This is because, first, as a contract manufacturer, the products we make for our customers are controlled by the customer as how that is defined in the new standard. Secondly, the products we manufacture do not have an alternative use for us, and we are entitled to payment for performance to date as also defined by the standard. So what this does to our Rev Rec is essentially move our industry from a manufacturing to a service accounting model. Maybe that is appropriate because the more I think of what we do and how we market ourselves, we are an extension of our customers where we take over the supply chains, logistics, needs, and design, manufacture, deliver, and provide after-sales services to meet specific customer requirements. Although I think this may actually be the correct revenue recognition model, it is a significant change in mindset for our investors, analysts, and for sure within our own company. Now I'm going to try to walk through a brief example here where I want to demonstrate how this standard can actually impact our industry. It may not be point on for you, but perhaps this may be useful to stimulate some thinking for those of you that are listening in, if I haven't lost you already. So let's take the example of a server or a set-top box. Simplistically speaking, the final product in the eyes of the customer is the box we deliver. However, the manufacturer of this box goes through several stages, which I will call sub-processes, such as printed circuit board, PCB assembly, sub-assemblies, the backplane, mechanicals, wiring, and then final assembly to get to that finished product that we finally ship to the end user. The total manufacturing time could be anywhere from a few days to a couple of weeks, and at any given point in time, a product will sit anywhere along this process. When a product has reached the end of a sub-process, such as a PCB or PCB assembly, we would have cost information that is accumulated up to that point directly from the bill of material. We would not, however, have direct labor, overhead, or other costs that are directly attributable to the finished product, nor would we have an allocation of the pricing attributable to that particular element of the finished good. Now, as background for you listening, the margins on the manufacture of a bare board is not the same as margins for PCB assembly, mechanicals, or other sub-processes. So a straight cost-to-cost percentage of completion accounting doesn't make sense for our model. Further, we may or may not have IT systems in place to measure a percentage of completion for the sub-assembly within the total manufacturing process. So that is one of the most significant areas where we're running into problems with the new standard. If we are to recognize revenue for product that is anywhere on a manufacturing line, it would require significant estimates and assumptions that would be made separately across the over 100 facilities we have globally. That's a problem. This is only one of the implications for our company and industry, and I will now talk a bit about what we've done so far with our EMS peers. A certain Big Four accounting firm has pulled together an industry coalition that includes several of our competitors. Now, why I'm raising this point is because an industry coalition is extremely useful for tapping others' ideas on how we address issues like this. For example, one of our peers had the very useful insight that measuring revenue at a point in time over the spectrum of the entire manufacturing process could be accomplished at completion of the subassembly process instead of within. That's key. The takeaway here is that we already have intra-business processes in place that track the movement of a product from one sub-process to another with transfer values attached to them. These values, for the most part, are most likely our best estimate of the actual value added at each of these stages. So I have the pricing allocation I'm looking for as well. We believe this will enable us to recognize revenue over time in the spirit of the standard, and would be doing that in a manner that is considerably less subjective for our sites. I don't mean to imply we've concluded anything here, but it's clear to me that we may have spun our wheels on this particular topic for months, going down a path we didn't have to do if we did not have the benefit of speaking openly with others who are in the same boat. Now, another significant impact for us is multiple element accounting. In spite of what I've just been talking about, there is upside to the new standard for us in that we are finally getting to an answer that truly makes sense for our vertical integration model. And that's because we no longer will be held hostage to the SEC's bill and hold rules. Now, what these bill and hold rules have meant for us historically is that irrespective of whether we provide a separable logistics and warehousing arrangement for our customers, we could not recognize revenue until final delivery as a result of these rules. And that's primarily because the SEC has viewed us as being a manufacturing entity only. So we've approached the FCC staff on this topic over the years and not been able to change their minds. Under the new standard, however, we would be able to recognize revenue on each performance obligation as we deliver, provided the FCC doesn't come on top with another separate interpretation, which is anybody's guess at this point. We're hoping. Briefly, and I know it may be too late for that, we're also struggling with the implications of the change in RevRec will have on our inventory. Effectively, we're going to be holding inventory with physical risk and title until manufacturing is complete and the customer takes physical delivery. Yet as we are recognizing revenues, we do have a cost that includes part of the bill of materials associated with that inventory that we're going to have to flush through the P&L to have appropriate matching. So the question is where do we put it on the balance sheet, the inventory that is? The answer isn't clear for any of us right now, and there for sure will be a number of metrics impacted and questions that are going to be very difficult to explain to the external and internal parties that actually are users of our financial statements. So with that long-winded response, I'm now going to turn it back over to Lark.
Thank you, Kevin. We will go into our second polling question. We've had some questions on when our next one would be, and we are administering the second of the 5 right now. So the question is if the effective dates for the new revenue recognition standard are extended beyond the current requirements, does your organization plan on moving ahead with a transition strategy in 2015? And while you're answering, I do want to let you know we have asked this question on the past 2 webinars as well. So we are giving you the options of yes, no, or don't know. And once it looks like everybody has answered, I will show everybody the results, and I'll let you know how it compares to the past 2 webinars. We are starting to receive a number of good content questions, so go ahead and send those in through the Q&A feature on your webinar screen. We're collecting those, reviewing them, and we are planning on addressing as many as we can at the end of the webinar. So as the speakers are talking and you think of a question, go ahead and type it in. We'll log it, and we will do our best to cover as many as possible during the Q&A portion of our webinar. So we'll go ahead and flip to the results. A good number of the attendees have answered this question, and the results show that over half of the attendees don't know. They don't know what they're going to do if when it comes to implementing a transition strategy, if the revenue recognition standard is extended. And I would like to say that that is very consistent with the past 2 webinars. People still don't know. The last 2 webinars is closer to 60%, but still there's a lot of people are still thinking about what they're going to do. So at this time, we'll go ahead and move on with the content portion of our presentation. Steve, I'll turn it back over to you.
Thanks, Lark. Maybe before we go forward, I'll bring up one of the questions that's come up, and Kevin and Chris, others could weigh in on the response. So what the question was, are there any trends as it relates to companies deciding to do the retrospective or on a prospective basis and some of the decisions? that are made. And I think the answer at this point is we don't know, because companies have not made that decision public at this point. As time goes on, we may get a better sense for that. But I think there's some key considerations the companies would think about, and I'll let Chris and Kevin weigh in on these. But from my perspective, one would be is that if you chose to not restate the prior couple of years, and the impact of this on your accounting model was to pull revenue that you would recognize later, have that done earlier, there's the risk and the very likelihood that you would be having revenue that would never be recognized in your income statement. It would go through the cumulative catch-up to retained earnings. So to miss the opportunity to report revenue for most companies would be fairly significant. On the other hand, on the retrospective approach or the prospective approach, on the surface, it would seem that that might be an easier and require less transition. But Chris, Kevin, any thoughts as it relates to that as companies start thinking about those two different adoption approaches?
Yeah, Steve, the only thing I would add to that, other than anecdotally, there are those with whom we've spoken privately, it seems to, if it's going to be significant to them, they're more likely to also be thinking retrospective, just for the point that you mentioned, which is to never have a year where an amount of revenue that never hits a P&L. That said, I think one of the considerations that they have to bake into their decision, in addition to what does the audit committee think, is one, and since they should be involved in a decision like that, depending on their charter, and is the data likely to be auditable when you get there? In other words, to liaise with their external auditors to make sure that everyone agrees that if that's their decision, that they wouldn't get to that year and not be able to go back and retrospectively recast the previous 2 years.
Yeah, and this is Kevin, and I fully agree with everything that's being said. I don't think it's any surprise to anybody that if my recommendation to our company's board and our CFO is that we would do retrospective application, and that's largely the reason why we're commenting the way we are to the third question of the FASB's request for comment. Of course, the one-time impact in revenues is huge, and we want to be able to show on our P&L what our trended numbers are going to look like over the prior 2 years, 8 quarters, however you want to present it, to keep the analyst community focused appropriately on what's actually happening in the current year, and to take away from any distraction there would be from the adoption of the new standard.
Thanks, guys. This is a roadmap, a sample of a roadmap for the transition. Many of you on the call may be far down the road. Many of you may be on the far left-hand side of this and just scoping what this might mean to the organization. So we thought it would be helpful to just take a minute to talk through a logical way, that methodology that you ought to be thinking about how this might apply to your business. Certainly companies at this point in the scoping, the analyze phase, you can see the 6 elements of infrastructure on the outside of the circle. So companies are really trying to think about what does this mean to our organization. The first step is thinking about what the changes it's going to be to your accounting policies, your accounting model. And then from there, begin to think about beyond the accounting, which for some companies, getting the accounting right, figuring out what the accounting model is, might be one of the easier things that needs to be done, because they'll figure out the accounting, and then that's how do they get the data and the information, put together processes and use technology to enable those processes to report that on a timely and a consistent basis. So a fair amount of thought needs to go on at least at the beginning of this. Like with any other significant transformation activity in your organization, careful planning, we believe, is going to be a critical success factor. Our focus of these webinars have been on these elements of infrastructure, And this is a slide for those of you that have been on prior webcasts that we've had, which looks across the organization. What are some of the things, some of the questions that companies ought to be thinking about when they're scoping, performing a diagnostic, and really thinking about the organization? And as you can see, the business policies, the accounting policies, your accounting methodology is only a portion of the things that companies need to be thinking about. So it's really important that companies consider the broad implications of this, look at it on a holistic basis. Otherwise, you run the risk of this simply being a finance and accounting exercise, and we believe that this is certainly has far-reaching implications in the organization. In addition to the infrastructure considerations, many companies are looking at this cross-functionally. So as you can see across the top of this slide, you've got those 6 elements of infrastructure, and then as part of your scoping and analyzing and considering what changes are going to need to be made to the organization, this identifies some of the key stakeholders in the organization and some of the considerations. And as you can see, this is going to touch on a lot of different parts of the business because this potentially impacts folks' commissions, compensation. Certainly the accounting and finance group are going to be impacted by this. They're the ones that are going to be tasked with gathering the information for the historical reporting, and let alone they also have the burden as it relates to the forecasting of this. So a number of companies have simply focused on the implications of their historical reporting, which is certainly critical, but equally critical, especially for a public company, would be how do you forecast this? And I think the guys from Flextronics will give us some thoughts about that later on in our discussion. Certainly for a public company, the internal audit, the Sarbanes-Oxley ramifications, those folks ought to be part of that because there's likely to be some business policies and processes that are changed. Certainly the Treasury function, which is monitoring activity related to reporting, and it could be everything from debt compliance to income tax reporting, a number of different things. And those aren't the only functions that are involved. This obviously will touch on sales and marketing. We've had several clients that, in light of this new proposed revenue recognition model, have thought fundamentally about how they put together their contracts and how they bundle their services. So many companies are actually stepping back from this and from a marketing standpoint and looking at how they're packaging the services and solutions that they provide and rethinking that. And certainly it's going to impact your sales organization because most of these sales folks receive a commission based on when revenue is recognized. Our focus of today's discussion is going to talk about some of the IT. Our IT shops in most all of our organizations, they're overwhelmed with requests. This is one more item that needs to be added on, but we think it's fairly critical. And certainly the operations group in organizations, the internal reporting, which we'll touch on later, that becomes really important. And the legal group is not exempt from this because they're involved in the contracts. They're involved in some of the, in certain companies, some of the investor relations. So as you can see, the potential impact of this and considering right now as you're scoping and analyzing this, think about the accounting and the potential ramifications and reporting ramifications, but extend that to the other elements of infrastructure and really look at it as a cross-functional team. One of the things that we think is really critical, and many companies have done this, if you haven't done this, we would suggest that you do some type of a formal assessment diagnostic process. This slide outlines the items that would be looked at as part of a diagnostic. You can see that there's the element or the item, some background, where we're at as it relates to what is the question, what's changed as a result of this new standard, is it applicable to us, where are we currently, where do we need to be, how do we get there, what's the estimated level of effort and the estimated urgency. So that's a very thoughtful, methodical way to consider the potential implications, and the areas that that the companies ought to perform a diagnostic or be thinking about would be, there's some of those that are listed on this next slide. So establishing a steering committee. And that steering committee would have cross-functional and C-suite participation. Be thinking about this transition method, whether the company is going to do this prospectively or retroactively. There are other transition decisions that need to be made. Really looking at the 5-step analysis and figuring out what the differences are between what you're reporting today and what you might be reporting in the future. Assess your capabilities of the system. CAMIC is going to talk about that. For many companies, they may need to run parallel reporting for a period of time, which is another set of books. And that was going to require capacity on servers and a number of investments that need to be made on technology. And then we believe it's really important that you establish a strategy and lay out a timeline and a roadmap that holds people accountable, that you can show the board, to your external advisors, external auditors, et cetera, that how you're going to get there. And then be thinking about the other implications as it relates to reporting in the organization. Here's just a sample of a diagnostic, and as you can see, it's not the entire all the columns, but for example, in establishing a steering committee, this is the sample of a diagnostic that we've used with some of our clients. But it kind of gives you a sense for, this is a formal document that has all these key considerations and all of the questions that you need to consider across those 6 elements of infrastructure. So it's focused on the accounting ramifications, the people, process, and technology ramifications. So if you haven't conducted a formal assessment, a formal diagnostic, it's something that we suggest companies do and think about. And you may need to get external folks that can help you and your teams think through this. Again, I would just remind you, I think it's really important that we would suggest that you look at this on a holistic basis. As it relates to systems data and reporting, you can see some of the key areas that, again, we're going to spend the rest of this webinar talking about. So with that, Kevin, I would be interested in your perspective as you've been through the assessment process, the diagnostic. Could you provide an overview of that for us and maybe some of the key lessons learned and insights that those listening on the call might appreciate?
Sure, Steve. So we started the diagnostics on our own, and I think it's obvious to say from my earlier soapbox discussion, it wasn't very efficient because we didn't have our arms around the appropriate accounting model to start with. This was further exacerbated by the sheer magnitude of our company's operations. The procedures we performed certainly help us to understand processes at the factory level better, so all was not lost, and thankfully we were able to realize that we needed some external help earlier in the process rather than later. But I'm now going to ask Raji to talk about this a little bit more. Raji?
Thanks, Kevin. So we started our diagnostic looking at what we perceive to be the most significant impact to us, which was the requirement to recognize revenue over time. After we had studied the standard and assessed the impact on us in terms of timing of RevRec, we discussed our assessment and conclusions with our external auditors. During this quote-unquote, what I would call the fact-finding phase, we had regular meetings with our external auditors just to make sure that we are heading down the right path. And once we have made certain conclusions and agreed with our auditors, then we dove in deeper into our manufacturing processes at certain selected facilities or sites. We held meetings with our operations personnel, walk through some of our manufacturing processes to understand what type of systems and processes are in place that may allow us to measure percentage of completion. Oh boy, that was not going too well for us. We were getting lost in the details pretty quickly in terms of the IT systems and across our various vertical services that we were offering. So what did we do thereafter? We pulled back, and as Kevin mentioned earlier, we went back to our EMS coalition, which actually helped us to get back our focus on what the real issue at hand is. And coming out of these meetings, the EMS coalition meetings, we started revisiting our initial thoughts, which were to recognize revenue throughout the manufacturing process, and started leaning more towards recognizing revenue at certain measurable points during that process, instead of throughout the process, as I mentioned earlier. This is a huge change in our thinking, and we actually believe that this is a more practical approach to the application of the rule while complying with the spirit of the standard. Effectively, we want industry-wide alignment in terms of how to apply the standard while respecting the spirit of it. Once we have industry alignment, then we will get our respective auditors on board, and if necessary, we may pre-clear certain topics with the SEC. That's not decided yet. We are first going to develop an accounting model, definitely, in collaboration with our industry peers and also with our external auditors. We fully acknowledge that this standard impacts tax, FP&A, IT, and probably even investor relations. But we believe that having a solid accounting model in place before having these cross-functional dialogues would be helpful in having those dialogues in a more efficient and effective manner. We certainly want to try and leverage the existing systems as much as possible. Not big fans of creating the wheel. And it's too early at this stage to assess what the impact would be on our IT systems. Certainly, internal controls are going to get impacted. We acknowledge that, primarily around revenue recognition and inventory management. So with that, I will turn this back on to Lark.
Thank you, Rajiv. We will open up the polling question for everybody, so we'll go ahead and flip to that. This is the third polling question. It says, has your organization established a steering committee to provide oversight of the transition to the new revenue recognition standards? So we're giving you multiple choice options, yes, no, don't know. And we have a little bit of a typo in there. It should be don't know, not don't know. So don't know is what that third option should be. Sorry about that. So go ahead and answer that question. We'll give you some time to do that. And some people have been asking questions about the CPE certificates, and I just wanted to remind everybody the CPE certificates will be emailed to you if you do answer 4 out of the 5 polling questions during today's webinar. You'll receive them within 2 weeks of the event. We will have 2 more polling questions after this after this one throughout the webinar, so please do stay on for the duration of the webinar so you can answer those polling questions and also get some really good information about the systems and reporting aspect of the standard. And we will continue to keep showing you the results. So this is a question that I think is interesting, especially based on what Steve had just covered. So we'll go ahead and flip to the answers and we'll show them to you. And the majority of the people on the webinar answered no, so they are telling us that they have not yet established a steering committee to oversee the transition to this new standard. So that gives you an assessment of where your peers are right now. We do have over 1,000 people on this webinar, so that's a good indication of what other people are thinking on this webinar. So we'll go ahead and start the systems portion of this webinar, and Siamak, I'll turn it over to you.
Thank you, Lark. Based on all of these discussions about new standard policies, business processes, and everything, at the end of the day, you need systems and data to manage and support these processes and policies and activities. So what I'm going to share with you is just providing some information that why is it important to think about new systems or changes to these systems early in the stages of your preparation rather than waiting and at the last minute when everything is done from theoretical perspective about your policies, your technical accounting and others, saying that, okay, where am I going to take my report now? And how am I going to handle some parallel reporting during a transition period and so forth. So that is what, in a nutshell, I wanted to share the experience and recommendations here. First of all, the reporting environment in general, that's a given, should be scalable and should be relevant really to your business requirement, and it should provide the information online and in real time. If you don't manage this element properly, the firm is going to be exposed to the risk of not having the available analysis and reporting at the right time and with the accuracy that is expected to have. So this is really the importance of this element. To do that, the question is, if anyone says, I'm aware of importance of reporting and data and system element and everything, so that is important to recognize that, and based on that, saying that how am I going to do it actually? So this is where we recommend the slide that you see here. Really, the approach that we recommend is to design the solution that you need for your system and data and reporting in advance, very in an elaborated way. It is like a house. If you are going to build a house, there are two ways to do that. Either you wait until the last minute, you are going to hire workers and everything, you come and individually you go with the workers saying that I want electricity here, water here, and so forth. And they are going to do that based on their individual knowledge to do something. Whatever comes out of that house may or may not satisfy your requirements. Or you go to an architect saying that this is the type of house that I want to have, this is number of my family, other characteristics you provide the architect. An architect is going to design a solution for you, saying that this is really, if you want to live in this environment that you explained to me, this is really the solution that you have. So the stages of designing that solution for system and data to support the revenue recognition model, these are the 7 stages that we have described here, that you start from understanding of all of these policies and rules, design a conceptual solution behind that, and then build a prototype, assess that prototype, and say, based on this prototype, if I want to generalize that all across the enterprise, what is going to be the cost and how am I going to roll it out. This is really the approach that we recommend, and we call it a solution design approach, with the goal of having visibility in advance to where you want to go with your system and data, instead of waiting to the last minute and just push it on the desk of IT saying that, okay, I have a new policy, these are requirements, do something about it. That brings us to this discussion actually on this slide. What we have here actually is the summary of what Steve, Chris, Kevin, and Raji, they provided. In a nutshell, the new revenue recognition principle is a contract-based model. Talking architecture, the whole point is that is your IT environment in accounting, sales management, administration, pricing, and all of these other relevant elements, do they support a contract-based model or not? If they don't, then you need to build it, or somehow you found it. In a nutshell, what's going to happen, first of all, your systems should be able to capture automatically the events that qualify by revenue recognition, that they come to the data that you need for revenue recognition. And then you need to identify the source of this transaction, which is going to be contract. Even a sales order now is going to be considered as a contract, or the contract by itself. If you are managing it somewhere else, now they should come to your main systems. And after that, you need to go and understand that what are really the separate performance within this entity, which is the contract. And then what is the price that you want to use to revalue actually this contract, because you may have a sales order that is $1,000 for the sales that you have done, and the customer has paid $1,000, but you can recognize $200 of that. But to take this, you need to reprice it and bring new calculation in it, and finally saying that, okay, this is really the type of revenue that I'm going to post into my general ledger. So if you are not going to revamp your systems to do that automatically for you, you have to do this manually. And based on the complexity of your company and your organization, that may not even be possible to do that manually. Even if you are going to hire 15 people, that may not happen actually. So that is important to assess the implication of all of these as soon as possible. If there is important changes to the system, should be thought in advance. This slide, in a nutshell, what tries to do, saying that what are really the applications organized by business processes that are going to be touched for a typical company. So wherever they are dark blue, actually, these are the applications that fundamentally they are going to be changed if you want to capture at the source transactions that are going to impact the revenue recognition recalculation for your reporting. And also, as Steve brought it up, you need a double environment or parallel environment. You need whatever you have in the past, and then you need whatever you are going to put in place in the future, because you are going to have a transition period. That is why this slide, the components of that, are they going to be duplicated? Are you going to create a shadow environment? So all of these are very important architectural questions that should be discussed at the appropriate time. And finally, this slide, which is kind of complex and crowded, what it tries to show is that at the upper part of the slide, you have your data in an ERP system or whatever system you do to manage your transactional activities every day. Also, it shows where you manage your master data. And master data and these transactions are very important because they define your system-wide engagement. That is where, for the first time, you collect data before putting that in the system. And then when the final version of that data is going to become system of record. So you have system of engagement and system of record that are going to define the lower part of this slide, which is really a revenue recognition engine for a company, a high-tech company, let's say. So they are about 4 or 5 element components at the lower parts that should be used to calculate or recalculate the revenue that you are going to recognize. Even if you are doing this with an Excel today, the macros and logic that you have built in the Excel still have these elements that you have in the lower part of the slide. So important thing is, if you are doing this today somehow, using these kind of components manually or automatically to do your revenue recognition, it has taken probably months, if not years, to build what you have. And as the things are going to be revamped and fundamentally changed, all of these components are going to be changed. And again, imagine that if you have 3 months now at the end, and you are going to work with your IT saying that I have to make changes to this complex environment that you can see the guts of it here. But you can guess what the answer is going to be. Even today, you go to IT, you ask anything that is way simpler than this, you have to wait in the list probably 3 months. Now imagine that you are going to ask these kind of changes. That's a no-go. So it is very important to start thinking about the architectural changes of systems, how it should work. Your IT people should get educated about these standards so they can think about the models that's going to come to the picture and related activities around that. So this is really main message, to be proactive about the systems instead of being reactive. That being said, I turn it back to Chris for the rest of presentation.
And I think we have a time for some words from Flextronics, and then a polling question.
Thanks, Chris. This is Raji from Flextronics. Yeah, so in terms of systems, as I said before, there's not a whole lot of change that we anticipate. We are trying to leverage our existing systems as much as possible, and being involved in the EMS coalition and this practical experience that we are trying to work with our auditors would certainly help in that. So at this point, we don't anticipate any serious changes, and it's too early for us to assess what it means for us in terms of systems. In terms of data, the most significant things that would impact us would be in terms of identifying all the performance obligations and allocating the transaction price to all the performance obligations. That being said, we would have to look at customer contracts, statements of work, purchase orders, and we'll have to identify all those performance obligations. And then another aspect that is pretty commonplace in our industry is pricing true-ups and customer claims that would impact certainly the allocation of the transaction price across the various performance obligations. So those are the things that we see in terms of data that will significantly impact us. And plus, we believe right now our systems are very decentralized. We believe we might have to have certain procedures at a corporate level to look at contracts and sales orders, etc. That is the impact assessment that we've done so far, but it's very primitive at this stage. And with that, I'll turn this back over to Lark.
Thank you, Raji. We will go into our fourth polling question. And this one, I'll go ahead and open it up. Oh, sorry, we got off a little bit, so we'll go ahead and change it. The polling question that should come up a little bit right in front of you now is, has your organization started to assess the impact of the new revenue recognition standard on data requirements and related data system, IT systems? So this relates to what Siamak was just talking about when it comes to the system impact that this revenue recognition standard will have on organizations. So it's not just an accounting issue. It is definitely an IT issue because IT systems drive our organizations these days, so it's something that we all have to consider. So yes or no is the option. We'll give you a little bit more time to answer the question. And quite a few people have asked me how they can access the recorded versions of our 3 previous revenue recognition webinars. And I do want to let everybody know we have made those links available to you in the resources area of your webinar screen, so they are there for your on-demand viewing. When we send you a follow-up email with a copy of today's presentation and a link to today's recording, we will also include the links to the 3 previously recorded webinars as well, because they all build on each other and they're good foundational knowledge on this particular topic. So we'll go ahead and take a look at the polling results for this question. And most of the people on the webinar, again, we have over 1,000 attendees on this webinar today. They said that 65% of you said no, you have not started assessing the IT impact that this revenue recognition standard will have on your organization. And almost 35% of you have said yes, you've started that process. So thank you for sharing with us your perspective on that question. And Chris, I'll turn it over to you.
Great, thanks, Lark. And I'll cover some of the reporting considerations beyond the obvious, right, which is that if you're going to change the accounting for revenue, you'll have potentially significant impacts to the basic financial statements, the balance sheet, the P&L, the statement of cash flows, the statement of shareholders' equity. But there are a number of other things to consider when we think about reporting, in particular some of the internal reporting and some of the tangential reporting. what you see on the screen now is a slide that kind of takes us back to the 6 elements of infrastructure that both Steve and Siamak have gone through. And the succinct way to state this is that internal reporting and external reporting in the end needs to be on time, prepared with the appropriate frequency. It needs to be useful, easy to use, and it needs to be accurate. The information needs to be captured succinctly, and it needs to highlight key points for decision making so that it is a tool as opposed to a report for academic purposes only. And so with that in mind, there are a number of areas that will be affected beyond the basic financial statements. The first of which is the incremental footnotes that will be required. Sort of the price of more flexible application of accounting, if you will be a lot of disclosure. Theoretically, we haven't seen it in practice, but theoretically, two companies could evaluate the same set of facts and come to either the same or slightly different conclusions and both be right based on some of the subjectivity that might be afforded them under the new standard. The way analysts would level set that would be to look through footnotes, the disclosures, to see what makes them different or similar. And so companies will, based on the way the standard is currently worded, have to report a number of things in the footnotes, the disaggregation of revenue by type, information about what balances remain on contracts, what contract costs have either been capitalized or which used to be capitalized have been expensed, what performance obligations exist in one box, and then in another, those that remain, which is essentially the deferred revenue if you've been paid, what judgments have been made. Think about if you have time value of money, what discount rate you've used, because that's a subjective call, and your discount rate might be different than your competitors, and you're both reporting information using present value, for example. What policy decisions you've made around value and cost to obtain a contract. How you've allocated the transaction price, if you've used methods and assumptions, if you for some odd reason love VSOE and couldn't bear to part with it, which is doubtful, but if you chose to use that as your means of estimating the selling price, then you need to tell the world that. If you used a more subjective method or the residual method, you need to tell the world that as well. And so there will be more disclosure as a consequence of the footnote requirements that come with the standard. And then, and Steve touched on some of this in his remarks as well, it's the internal and external reports. So a number of reports that might not come to mind immediately when you think about the basic financial statements, but to what extent, and Steve covered this, does your commission and bonus structure derive from GAAP revenue? Well, then do you have to deal with commission, bonus, and compensation reporting? That is different. If you are a partner in a partnership or an alliance or a joint venture, are you the books and records partner? And are you required then to recast revenue and then tell your partners about it if you're not the books and records partner, but you're consolidating or using the equity method or some other method to reflect the information in your P&L? Are you certain that the other party that is the books and records partner has adopted the new standard and done so accurately? And what's your comfort there? If you're in M&A transactions and you've got working capital adjustments that are based on earnouts, what does the contract say about GAAP changing in the middle of an earnout period, and what do you have to do to make sure that you're producing the data you need to comply with that contract and measure the value of the company and pay more or less based on that? Do you have covenant compliance to deal with from a loan perspective? Management reporting and budget reporting obviously are in forecasting to the extent that revenue changes. Well, revenue forecasting is going to change as well. And then the Sarbanes-Oxley and internal control compliance. And again, Steve talked about this to some extent in his walkthrough of the 6 elements of infrastructure. But if you change an accounting policy, you're likely to change processes. And that is going to lead to changes in process maps, perhaps controls, test plans, and tests, which ultimately could be manifest in some difference in reporting internal controls over external financial reporting in accordance with COSO Framework 2013 and Sarbanes-Oxley. And so there are a lot of other things to consider beyond the basic financial statements, and we think it's important to focus on those as much as they enable you to help run the business and comply with other obligations, as well as the external financial reporting. And with that, I believe we'll get some thoughts from the folks from Flextronics.
Thanks, Chris. Yeah, definitely. I mean, couldn't agree more with everything you said. Great points highlighted. For us, in terms of disclosures, we haven't put a lot of thought into what it means to us. Obviously, we understand everything that Chris said and certain others as well. we are a company that's heavily focused on forecasting, so we understand that that's going to be a tough task for us. Today we are basing our forecasts on a delivery model, and that itself is hard for us because our customers' orders or demand is driven by their end users' demands. So imagine having to forecast on a continuous rev rec model. That's going to be even harder. So we fully envision that. And then in terms of matrices, which we use internally as well as certain matrices that we report externally, they're going to be impacted as well. Net working capital is one that I want to highlight, which is very significant to our industry. We define it as inventory plus AR less AP, and we all know that inventory and AR are probably going to get impacted as a result of the new standard. So that's where we are in terms of the wholesale disclosure requirements. We are yet to make a full assessment. Back to Lark.
Thank you, and we will go through our fifth and final polling question at this point in time. So the question is, has your organization started to assess the impact of the new revenue recognition standard on revenue reporting and related processes? And this is one we've been asking over the last 3 webinars, so this will be the 4th time we've asked it. So go ahead and answer it. It's a yes or no question. People are still asking how they can access the recorded version of the past 3 webinars. They are available for on-demand listening through the links, the resources area in your webinar screen. One person did ask me if they had to register to listen to the on-demand versions, and the answer is yes, you must register to listen to all 3 on-demand versions of our past webinars. So we hope you do listen to them. It gives some, as I mentioned before, it provides some really good foundational information. We went over that information in summary form today, so you can take a deep dive into each one of those topics. They are 90-minute webinars each, similar to today's. So there's a lot of really good information in there. So we'll go ahead and look at the answers to this particular poll. Like I said, it is a question we've been asking over the past 3 webinars, and the good news is that the gap is closing on this particular question. So when we first asked this question in November, the results were 66% said no and 34% said yes. So now we are getting closer to the middle of where 49% of people said yes today and then 51% said no. So people are making progress within this particular area. So we'll go ahead and transition to Steve, who's going to take us through a few questions, and then we'll close out the webinar.
Great, thanks, Lark. So the first question, and I think it was generated, CMIC, by some of the discussions, but so I'll address this to you, CMIC, is are the Tier 1 and then maybe the Tier 2 ERP, have they been able to develop modules or bolt-on applications that are going to make it easier for companies as they go through this transition from a technology standpoint?
Yeah, the short answer is yes. There are bolt-on applications that have been developed either by ERP vendor itself, or they are available as third-party applications that can be integrated into major ERP systems. SAP has not developed anything for revenue recognition separately. When I say revenue recognition, I'll make a distinction between revenue recognition and amortization. They have functions and subcomponents to do revenue amortization. You give amortization capabilities or criteria, and they amortize revenue. This is not revenue recognition. To enter different rules and criteria really to calculate how you want to recognize revenue and based on what risk you want to recognizing, all of those complex areas that we discussed, you need another generation of tools. Oracle has released a revenue management tool, which is new, and it is compatible with some industries. Otherwise, there are third-party tools such as RevPro and SoftTrax and everything that have been out there for a number of years, providing automation of revenue recognitions. And as far as I know, they are revamping their solution to account for these new standards.
So it sounds like, Siamic, that just with the existing revenue recognition language, or requirements, for the existing pronouncement today, it's very difficult for a company to find an off-the-shelf solution or a module that's part of a larger ERP package that they can simply plug in and play. It requires a fair amount of customization and oftentimes some other tools to augment. Sounds like we're going to be looking perhaps at the same type of situation as we go forward with the new RevRec rules. Would you agree?
Yeah, it is. It is a significant effort. There's no plug-and-play solution like this. Yeah.
Great. So one of the other questions, I'll throw this out to Kevin and Raji at Flextronics, and Chris, you can weigh in on it as well, is what are the responsibilities of management versus the auditor, and both from an internal and external audit? So I guess the real question here is, what kind of interaction should management be having with external and internal auditors?
Great question, and this is Kevin. I think you have to be, the approach that we're taking, I don't want to preach to anybody on the call, is 100% open kimono, open disclosure with your external auditors. With the complexities that we're facing, we don't want to make conclusions internally and move down a path without having them on board. A lot of these things they're figuring out right alongside with us. They're reading the same transition resource group conclusions and points as we are, and trying to figure out how this would apply to your particular business model. I see no reason to not be 100% out in the open with these guys, front to back, starting with the accounting model itself to the systems implementation and designing the controls around those implementations, which of course is when you'd start to talk to your internal audit team on policies and procedures, and all the way through the disclosures. This is so complex and so large for us. What I don't want to do is have an argument on the back end when we're getting ready to issue our first 10Q adopting the new standard.
And Steve, this is Chris. Just to follow on that, I think the internal auditor has a role as the liaison between management and the audit committee to make sure that the audit committee is comfortable with some of the key decisions, such as retroactive or prospective or early adoption or adopting just in time. And then, as the folks from Flextronics have indicated, full communication with the external auditor is new to them, it's new to the company. And although there's some subjectivity in coming up with the policy, they need to be in a position to understand how auditable they'll be, because that subjectivity really ends at the company's front door. It's not subjective at the desk of every accountant in the organization. And so they'll need to work together to understand how it's going to be rolled out and develop the right test plans to make sure that there's compliance, especially in the first year or two.
Thanks, Chris. I know a number of you have submitted questions, and we will respond to them. We thought we would just leave you today with some thoughts about next steps, maybe some key takeaways. I think you've heard from the presenters today you've heard some theoretical discussions and methodologies and approaches. You've also heard some practical implications from those of us that are working in the trenches, thinking through this, trying to figure it out. You've heard lots of discussion about transparency and openness and candor in the organization, to not underestimate the level of effort. So maybe a handful of key takeaways is, if your organization and the various stakeholders, including the board, are not educated on the potential ramifications of this, we think that's a real important part of the transition and any change management. If you haven't done an assessment or a diagnostic, no matter how formal or informal that is, that's got to be a great first step, because without that, you're likely guessing as to what it's going to be, and you could be surprised. begin to think about who else in the organization needs to be thinking about this. This has the potential to be a huge distraction to the business. And then realize that there's a number of key decisions that need to be made in this transition, and it's important that you thoughtfully think about those. And then be realistic about potential impact on the organization, the level of resources, the time commitment, amount of investment that needs to be made. With that, let me thank again Kevin and Raji from Flextronics for joining us. Appreciate their insight. Thanks to Chris, and to Siamic, and to Lark. And we hope this is helpful, and look forward to speaking to you again on our next webinar. Thanks again for joining.